did get more positive news on retail sales today. They climbed in the month of April for the 7th straight month, more than economists had projected. We also saw consumer confidence, sentiments up a bit today, too. Yet we're looking at jitteriness in the marketplace. For more perspective on what's going on in the markets this week, Barclays Capital Head of Research Larry Kantor joins us now from their offices in Midtown Manhattan. Larry, I'm looking at the euro falling to its lowest level since November 2008. LIBOR's up. We've got cost of insuring against default once again high in Europe. How are you so optimistic?
Well, in terms of the overall look, I mean, there are serious sovereign debt concerns, and by the way, the U.S. is not exempt from this. I mean, you know the size of our budget deficit, and we really haven't started addressing it yet. However, what's pretty clear to us is that policymakers have very little tolerance for a significant market setback. And we saw over the weekend the Fed roll out the currency swaps, the ECB even agreeing to purchase bonds, whereas even last Thursday they said they weren't doing anything. Look at, if you kind of step back and look at what's going on, the stock market's not even off 10% from its highs. And LIBOR's up, but nowhere near the kind of liquidity stress as we saw back in 08. And policymakers are ready to pull out all the guns here. So to me, that's a bullish sign, particularly in the U.S. stock market. This is really a European problem. It's not, at least at this point, a U.S. problem.
So you don't think that this could throw sand in the gears of what does appear to be a recovery gaining momentum if you read today's retail sales or confidence numbers as proof of that?
I don't. I mean, the one negative factor here is the dollar going up. I mean, the dollar had come off a lot. That was very good for our exports and for the economy in general. Now it's going up. But other than, and by the way, it should help Europe. And this is the right adjustment, a weaker currency to help Europe. But if you look at interest rates, I mean, if anything, in our view, this puts any Fed tightening even further out. You've got an economy that is likely to show growth in the second quarter of at least 4%. You've had, of the past couple of quarters, an average of over 4%. Employment's finally getting going. You cited retail sales haven't grown this fast in a long, long time. They've been growing about a 9% pace in the last 6 months. I mean, the recovery's finally getting into gear here. And yet you've got the Fed nowhere near tightening and at a rate of 0. That's a pretty good mix for risk assets. Right now, the market's very unsettled because the picture's still not clear in Europe. And given the memories of what happened a couple of years ago, people are very nervous about contagion to other markets. But this is more like the Thailand situation in 97, 98 than the Lehman situation of 08. It's really a localized regional problem. I think at the end of the day, look, there's a lot of volatility here, a lot of nervousness. I think this is going to end up being good for the U.S. markets.
And you make the point that policymakers have a certain put in here, that they're protecting us from broader crisis levels. Thank you so much for some perspective, Larry Kantor, this morning.